When I started trading, all I wanted to do was make money quick and easy, right? I had no clue about the basics of trading. I had no clue how the currency markets move. I had none of this. I didn't know what correlation between pairs was. I didn't know what a take profit was or a stop loss. All I knew is that if you click a few buttons, you can make a lot of money and you can lose a lot of money. I did know that, to be fair. But we only think about the positive. So I only thought that I could make money. And I'm pretty sure most of you, and I'm pretty sure you might have even thought of that at one point in your trading journey, wherever you may be. So today, in the Zero to Funded series, we're going to be going over the basics, and there's so many basics to go through. So it's actually going to be split into like different parts. So this is part one of the basics thing, and I've actually got a note of a few things I want to go through. So make sure to grab like a notepad, or if you already know these things, then maybe just listen. But before we get into the technical analysis, which is what I know a lot of you want me to go through, we need to get the basics, because I'm going to be guiding you to basically being ready to get funded in a very short amount of time. So in order to do that, we need to get the basics and build the foundations so that we know what we're talking about. And when I'm talking about these things later on in the course or the series, then everyone knows what I'm talking about. We're all on the same page. We all understand each other. So let's start. So this is primarily Forex. So this is all I'm going to be talking about. But what is Forex? Have you ever asked yourself that? So Forex, foreign exchange, is the largest market in the world, the global currency market. We are trading currencies. We're trading currencies against one another. The strength of a currency, the weakness of a currency. We are predicting, and with risk management and all of those things. So it's not gambling. We're not just clicking buy or sell. But we are predicting a high probability prediction whether we think a currency's value is going to strengthen or whether we think a currency value is going to weaken, pretty much. If we think it's going to weaken, we're going to sell the market. If we think it's going to strengthen, we're going to buy the market. Simple, I know. But in Forex, we don't use buy and sell. We use something called long and short. So if you want to buy the market, you'll hear people saying, I'm longing, or I'm long on this pair, I'm long on this currency. Same thing with selling. If someone thinks that, if someone's in a short position or they're selling a currency, they'll say, I'm short on euro dollar, I'm short on cable, I'm short on Aussie dollar. So you get what I'm saying. Now that actually brings me to a point that I didn't mention on my notes, but before I forget, two other words that you should know, and you've probably heard, but I'm just going to clarify it once more. If the market is going up and strengthening, then we say it's very, very bullish. Bullish means it's going up. Bearish means it's going down. So if I say I'm bearish today, which you've probably heard me say in my trade forecasts, all I'm saying is I think it's going to go down. If I said I'm bullish on this pair today, all I'm saying is I think it's going to go up. Do you understand? Pretty simple. But these words, they're very, very commonly used, very frequently used among the trading industry. So having these nailed down is, you know what people are talking about. And even when you're reading things, it's going to make sense. So I think those are really crucial. Am I recording? Yeah, good. But yeah, okay. So now that we've got that out of the way, long, short, bullish, bearish, currency markets, let's talk about how they're written. So on your TradingView chart, and before we move further on, I just want to say, go on TradingView, just type tradingview.com or TradingView and make an account. It's completely free to sign in and make an account and analyze. There are some other features which you have to pay the premium version for, but we'll get onto that later. And there's some loopholes around it as well. But just make an account on TradingView. So next time when we're on TradingView and I'm telling you how to set up charts and all of that good stuff and explaining how to use it, then you guys can do it alongside me. But yeah, get TradingView. But now, as I was saying, let's take an example of a currency pair. Euro, right, which is the currency for Europe, versus or against the US dollar, which is why I personally trade. Euro against the US dollar, which will be written as EUR slash USD. Euro dollar. The euro against the dollar. The strength or weakness of the euro against the dollar. Those are two currency pairs. Another currency pair could be something like pound yen. GBP, JPY. The pound, the British pound, the Great British Pound. I don't know why I was fumbling while saying that. Great British Pound versus the Japanese Yen. That's another currency pair. Aussie dollar, AUD, USD. The Australian dollar versus the US dollar. So those are currency pairs, and is all we're doing. Let's say I'm on a chart of euro dollar. All I'm doing is seeing if the euro is strengthening or weakening against the US dollar. If I'm on Aussie dollar, I'm seeing if the Australian dollar is strengthening or weakening against the US dollar. It could be something like GBP as well. The euro, and whether it's strengthening or weakening against the Great British Pound. So you get what I'm saying. So that's how a currency pair is written. So next time you see that, you know exactly what the chart is about, right? You're not going to get confused. Now, the first currency is called the base currency. So in a euro dollar, euro USD, the euro is the base currency. The dollar is the quote currency. Quote. So euro base, USD, quote. GBP USD, pound dollar, also known as cable. Pound is the base currency, and USD is the quote currency. So that's the names given to that. It's not really that important. I just thought I'll let you guys know. But you might be asking, what strengthens and what weakens a currency? So now there's two ways to look at it. I personally, and most traders on YouTube, do technical analysis. Now, technical analysis is the study of looking at the charts and basing your trades around, patterns or different technical indicators, right? You're looking at the charts and you're making a prediction based on the charts. Fundamental analysis, on the other hand, is looking at news events. Fundamental analysis, looking at interest rate hikes, looking at, new unemployment claims, inflation, all these things, and then building a narrative and a bias to why you're going to be selling the market, shorting the market, or why you're going to be longing the market, right? So there's two ways to look at it. Fundamental analysis, technical analysis. On this series, I will be covering fundamental analysis, but most of the teaching will be technical analysis. As you would have seen in my forecasts, they're very technical. I mean, I mentioned news here and there because that's another reason which we'll get into the risk management section, but technical analysis, fundamental analysis, that's all you need to know. A quick example of fundamental analysis is that, let's say interest rates are high. Interest rates are rising. Okay, an interest rate hike. What's this going to do to, let's say, the pound? Let's say we're looking at pound dollar, and the UK's interest rates are rising heavily. What's this going to do to the currency of the UK, GBP? What's it going to do? So, interest rates are rising. What will this do? High interest rates attracts foreign investors. Foreign investors investing into the UK because of higher interest rates does what? There's a higher demand for the pound. If there's a higher demand for the pound, what's this going to do? Just naturally to the pound. It's going to strengthen it. So that's just one example. High interest rates on a currency. I mean, it's all relative because, the dollar might be even higher. So, which is which. But just looking at one currency, if the UK's interest rates are rising, attracts more foreign investment, more demand into the pound. It just gives that higher value to the pound. Hence, you will see the pound's currency strengthening. Very bullish. Okay, and this applies to all the currency pairs. So that's like a little section of fundamental analysis. Obviously, there's so much more which we'll cover in fundamental analysis, but that's just a glimpse. So, I mean, you can choose what you want to do. Do you want to look at news and then base trades, or do you want to look at the charts and be a technical analyst? So those are the two, and I'm glad I got that covered out. Now, I think I don't want to take too much of your time, but I just want to get through some basic stuff. Yeah, this will take another 2 minutes. Two very, very important concepts you need to know, or trading terminology, is a take profit and a stop loss. Now, to some of you, this might seem like very, very basic knowledge, but I'm really sure there must be maybe, even if there's one of you who doesn't know what any of these are, this is what I'm going to tell you. So, when you're trading, let's say I want to buy the euro against the dollar. I think the euro is going to go up, so I want to buy it, right? But just because I want to buy it and I think that I've done all my analysis and I think it's going to go up, doesn't mean it's going to go up. Who am I to say it's going to go up and it's just going to go up? No one. It can easily go down. But when you're buying, you're making money. That's all well and good. When you're selling, when you're buying, you're making money. But once it starts to go in the opposite direction, then you're losing money. So a stop loss is there as a risk management tool to prevent you from taking more losses or a heavier loss than you want to. So let's say I have a £10 account, okay? And I'm going to risk, I'll make it easier, £100 account, and I'm going to risk 1% on that account. Every trade I do, I'm going to risk 1%. So I'm going to risk £1 on every trade I do. That's the maximum I want to lose, I'm willing to lose per trade of my £100 account. So let's say, got my £100 account, I'm going to buy Euro USD. I've placed the trade and it starts going up, I'm making some money here and there, but it starts to go against me, it starts to go down now. I wanted to buy it, but it's going down now. So I'm losing money. If my stop loss is at 1%, that means the maximum I will lose is £1. If I don't have a stop loss, it can keep going down and down and down and down and down. I could lose my whole account. That's one of the biggest things I see traders make, like mistakes I see traders making. I used to make it as well, not putting a stop loss. Why? Because you're so convicted that it's going to go up. It has to go up. It doesn't have to do anything. So stop loss is there to protect your risk, to protect your account. It's a specific level at price. It's a specific price, which you say that if the price reaches this level, I'm out of the trade. I've lost my £1, cool. I'm 1% down, cool. But at least you won't lose 2%, 3%, 50% of your account. So stop loss is there to protect your risk and to save you from taking bigger and heavier losses. It's a must in every single trade. You need a stop loss. So that's a stop loss. Now take profit, this is all well and good. Take profit is on the good side. You're making money. A take profit, just like a stop loss was a price where you want to get out of the trade and take your loss at 1%. A take profit is a price where you want to get out of the trade as well, but you make money. So if I'm buying, let's say the price is at 0. Let's just say for like a theoretical example. Price is at 0 on Euro USD. My take profit is I want to buy. My take profit is at 2 and my stop loss 1% is at -1. Okay, if price goes down and hits -1, I'm out of the trade, right? My stop loss was there. If price goes up, because I'm longing the euro dollar, and it hits 2, right? That's my take profit hit. I'm out of the trade as well. In both scenarios, I'm out of the trade. In the stop loss scenario, I'm out of the trade with a loss. In the take profit, I'm out of the trade but with a win. So whenever you trade, there's sort of actually 3 things you should look at. You should have your entry point, the price that you enter. So let's say 0. You should have your stop loss, which was -1 in this case. And you should have your take profit, which was 2. Okay, now these are just, random examples of price. But you get the point. If you're selling the market, then let's say your price is here where you enter. Your take profit is all the way down here, right? Your stop loss is above there. So if it goes up against you, then you're only going to lose a certain amount, which you're willing to lose. If it goes in your favor, the direction that you thought it was going to go anyway, then it will take you out of the trade with a profit. Hence, take profit. So that's all I want to cover for the basics, part 1 or whatever I'm going to call it. But there's going to be, I don't know how many more, but I mean, as long as it takes to cover the basics, really. But I want to get all the stuff out of the way, set the foundation, and then we can move on to the more fun stuff, technical analysis. And all that good stuff. But hopefully you understood all of this. There's some free things, free templates and all of those things I've made for you down in the description below. So make sure to check that out. If there are any issues, just set up a free call with me on my Discord. And yeah, I guess I'll see you whenever I see you next. I mean, I'm going to try my best to upload as many of these 0 to funded series. But I'll see you guys next week, 100% next week. But until then, stay safe, happy trading. Peace.